The significant surge in U.S. stocks on October 27, 2025, particularly the standout performance of Qualcomm, stemmed from a convergence of multiple positive factors. Below, we delve deeper into the specific reasons and market dynamics. Core drivers. 3 key factors propelling growth. First, easing U.S.-China trade tensions, the strongest catalyst for market confidence. The primary driver behind this historic surge in U.S. stocks stems from the significant easing of trade tensions between China and the U.S. Over the weekend, October 25 to 26, economic and trade teams from both nations held 2 days of consultations in Kuala Lumpur, Malaysia, reaching preliminary consensus on arrangements to address mutual concerns. This positive development completely reversed earlier market fears of further escalation in trade friction, bringing new hope to trade relations between the world's 2 largest economies. U.S. Treasury Secretary Steven Mnuchin explicitly stated in a weekend television interview that a framework agreement had been reached following the Malaysia talks, including China's purchase of U.S. soybeans and the suspension of rare earth export restrictions. This statement significantly boosted market confidence, as it signaled substantive progress in resolving the long-standing trade dispute. More encouragingly, U.S. President Trump later told reporters he had a very good feeling about reaching an agreement with China soon, further reinforcing market optimism. The substantial market impact of these positive trade talks stems primarily from 3 key factors. Direct relief for corporate profits. Easing trade tensions means tariffs imposed on Chinese imports may be suspended or even removed, directly reducing cost pressures for U.S. businesses, particularly in retail, manufacturing, and technology, and boosting profit expectations. Chip stocks, often seen as a trade barometer, received a strong boost, with the Philadelphia Semiconductor Index surging 2.74% in a single day. Improved global growth outlook. As the world's 2 largest economies, improved Sino-U.S. trade relations will significantly boost global trade flows and supply chain collaboration, injecting robust momentum into the currently sluggish global economy. The latest trade developments were the primary driver behind Monday's global stock market gains. Reduced market uncertainty. Easing trade tensions have diminished policy uncertainties for businesses and investors, encouraging firms to pursue long-term investments and capital expenditures while prompting investors to shift toward riskier assets. Wall Street's fear gauge. The VIX consequently fell to its lowest level in about a month, reflecting a clear retreat in market anxiety. Notably, the scheduled meeting between Chinese and U.S. leaders on Thursday, October 30th, will finalize the framework agreement. This pivotal gathering will provide clearer direction for future trade relations. Any unexpectedly positive outcome could further boost markets, while an unexpected breakdown in negotiations might trigger significant volatility. Second, Fed rate cut expectations, a strong stimulus for liquidity. The second key factor driving the surge in U.S. stocks is the market's strong anticipation of continued rate cuts by the Federal Reserve. Following last week's release of lower-than-expected inflation data, traders are nearly certain the Fed will cut rates again at its next 2 meetings, one of which takes place this week. This robust expectation of monetary easing has fueled ample liquidity expectations, becoming a major driver of the stock market rally. According to the latest data from CME's FedWatch tool, the probability of a 25 basis point rate cut at the October meeting stands at 96.7%, while the likelihood of rates remaining unchanged is only 3.3%. The probability of a cumulative 50 basis point cut by December has also reached 93.9%. This near certainty stems primarily from the following economic context. Persistent easing of inflationary pressures. Inflation data released last week consistently fell below market expectations, indicating that inflationary pressures in the U.S. are steadily moderating. This provides ample policy space for the Fed to continue cutting rates without excessive concern over runaway price risks. While the Fed initiated its first major rate cut this year last month, it hesitated to commit to further reductions due to worries about potentially fueling inflation. The recent weakening of inflation data has now alleviated these concerns. Signs of labor market fatigue. The U.S. labor market has shown signs of weakness in recent months. While consumer spending remains stable, the slowing trend in employment has drawn the Fed's attention. Stimulating the economy and supporting job growth through rate cuts has become a natural choice for the Fed. Data gaps due to government shutdown, with key economic indicators delayed by the U.S. government shutdown, Investors will closely monitor Fed Chair Powell's post-meeting remarks to gauge whether further rate cuts will occur in December and beyond. This uncertainty has actually reinforced market expectations that the Fed will adopt a more cautious and accommodative stance. The Federal Reserve's accommodative monetary policy primarily drives stock markets through three channels: lowering corporate financing costs, boosting market liquidity, and elevating valuations of risk assets. Particularly in the current environment where corporate profit growth faces challenges, accommodative monetary policy can directly increase the present value of stocks by lowering discount rates, serving as a crucial force supporting share price increases. Bob Dole, CEO of Crossmark Global Investments, described the current stock market as a high-risk bull market, underpinned by the delicate balance between loose monetary conditions and slowing economic growth. Third, tech stocks and AI themes, core drivers of the rally. The third key driver behind the recent U.S. stock surge stems from the robust performance of tech stocks, particularly those tied to artificial intelligence concepts. Large-cap tech stocks, epitomized by the Big Tech 7, broadly advanced, becoming the primary force propelling the indices higher. This year, approximately 41% of the S&P 500's gains stemmed from these 7 tech giants, underscoring their weight and influence in the market. Among numerous tech stocks, Qualcomm stood out with particularly dazzling performance. Its stock surged over 20% at one point, ultimately closing up 11.09%. The immediate catalyst for this remarkable surge was the company's announcement of its official entry into the AI data center market, unveiling 2 AI chips designed for data centers, the AI200 and AI250. This strategic move is viewed by the market as a significant step for Qualcomm in diversifying its business, breaking free from the constraints of the smartphone market and expanding into the rapidly growing AI infrastructure sector. Qualcomm's standout performance is not an isolated event but a microcosm of the booming AI industry chain. Other AI-related stocks also performed strongly. NVIDIA rose 2.8%, contributing the most to the S&P 500 index, while AMD closed up 2.67%. This collective surge in AI concept stocks reflects the market's extreme optimism about the development prospects of the artificial intelligence industry. 3 key factors explain why the AI theme has become a core driver of U.S. stock gains. Massive market size and growth potential. The AI data center chip market is valued at $500 billion. Even if Qualcomm's products cannot rival NVIDIA's, capturing a small market share could generate billions in incremental revenue. This vast market potential offers significant growth opportunities for relevant companies. Sustained expansion of capital expenditures. By 2025, the 5 major listed tech companies are projected to collectively spend nearly $400 billion on capital expenditures. Combined with OpenAI's commitment to invest over $1 trillion, these massive investments provide ample orders and revenue streams for the entire AI industry chain. In-depth analysis of Qualcomm's strategic transformation, from mobile devices to AI data centers. Qualcomm's AI chip strategy, a differentiated competitive path. Qualcomm's standout performance amid the global AI wave is no coincidence but a pivotal milestone in its long-term strategic transformation. On October 27 local time, Qualcomm officially announced the launch of its AI200 and AI250 chips and rack products on its website, all leveraging the company's neural processing unit technology. This move marks Qualcomm's formal transition from a semiconductor company primarily focused on mobile device chips to a comprehensive AI chip supplier. Unlike existing market leaders such as NVIDIA and AMD, Qualcomm has chosen a differentiated competitive path. The company explicitly stated that its new chips target the AI inference market, rather than the AI training market where NVIDIA holds absolute dominance. This strategic positioning is highly prudent, as it allows Qualcomm to avoid direct confrontation with NVIDIA in the training domain while focusing on a new, equally vast and rapidly growing market. The inference market is experiencing explosive growth as AI applications become more widespread and practical. Increasingly, businesses require running pre-trained AI models in real-world scenarios rather than training new models from scratch. From a technical specifications perspective, Qualcomm's AI chips feature several notable characteristics. High memory capacity. The AI200, slated for release in 2026, supports 768 GB of LPDDR memory per card. By comparison, NVIDIA's latest GB200 NVL72 platform equips each GPU node with 288 GB of HBM3E memory. High memory capacity is critical for processing large AI models, especially as model parameter sizes continue to expand, driving increasing memory demands. Low-power design. Qualcomm emphasizes that its chip's low-power memory technology delivers exceptional AI inference performance with industry-leading total cost of ownership. This energy efficiency advantage stems from Qualcomm's extensive technical expertise in mobile device chips, now successfully applied to data center scenarios. Flexible deployment options. The AI200 chip can be deployed as a standalone component, as an expansion card for existing equipment, or as part of a complete rack server provided by Qualcomm. This flexibility allows customers to choose the most suitable deployment solution based on their specific needs and existing infrastructure, significantly lowering the adoption barrier. Durga Malati, Senior Vice President and General Manager of Technology Planning, Edge Solutions, and Data Center at Qualcomm Technologies commented, "With the Qualcomm AI200 and AI250, we are redefining the possibilities of rack-scale AI inference." This statement reflects the company's confidence in its technological capabilities and clear understanding of its market positioning. Commercialization progress and market potential. Qualcomm's AI data center strategy extends beyond product launches, having achieved substantial commercial progress. The company announced Saudi Arabian AI startup Hamain as its first customer, planning to deploy 200 megawatts of computing power based on the new chip starting in 2026. This collaboration marks a significant milestone, demonstrating market validation of Qualcomm's products beyond laboratory concepts. According to Qualcomm, the AI200 and AI250 racks consume 160 kilowatts each. Deploying 200 megawatts would require approximately 30,000 AI servers, equivalent to a mid-sized NVIDIA H200 data center. This scale indicates Humain's strong confidence in Qualcomm's chips and willingness to adopt them extensively in its AI infrastructure. For the market, such early customer endorsement carries far greater persuasive power than technical specifications alone. From a market perspective, Qualcomm's entry into the AI data center sector holds significant growth potential. Massive market size. The AI data center chip market is valued at $500 billion. Even if Qualcomm's products cannot rival NVIDIA's, capturing a small market share could generate billions in incremental revenue. Considering Qualcomm's FY 2024 revenue of approximately $38 billion, even a 1% market share would drive over 10% revenue growth. Demand for supply chain diversification. Tech giants seeking to reduce reliance on NVIDIA have supported AMD and Broadcom. Qualcomm's AI solutions could gain acceptance from these companies as part of a risk diversification strategy. This second supplier approach is common in the semiconductor industry, where large tech firms proactively cultivate multiple vendors to ensure supply chain security and bargaining power. Valuation recovery potential. Prior to yesterday's surge, Qualcomm had gained only 10% year-to-date, far below the Philadelphia Semiconductor Index's 43% increase. This indicates the market previously overlooked Qualcomm as an AI chip stock. Its transformation could fundamentally reshape investor perceptions, creating opportunities for valuation reassessment. However, Qualcomm faces significant challenges in the AI data center market, most notably its underdeveloped software ecosystem. Compared to NVIDIA's robust CUDA ecosystem, Qualcomm lacks a comparable software ecosystem and does not possess NVIDIA's NVLink high-speed interconnect technology. These disadvantages could become major obstacles to expanding its market share. Additionally, while its 768GB LPDDR memory solution offers large storage capacity and low cost, it falls far short of the high bandwidth capabilities provided by NVIDIA's HBM3E memory chips. This means Qualcomm is unlikely to make significant inroads in the AI training market.